In March 2018, RRD changed the bright line test from 2 years to 5 years. In this video, we're going to explain how it's going to affect you if you have investment property. First of all, I have to mention this only applies to residential investment property. So it doesn't apply to your house, to farmland, or to commercial property. The other thing I have to mention, it doesn't override if you're a property trader. So you can have a property for a year and it's still up for capital gain tax because your intention was making money when you're selling the property. So it only applies to residential investment property. So the rule starts from 29th of March 2018. So if you show interest on a property on 29th or after 29th of March 2018, then you will be caught on 5-year bright line. So what it means to you is if you show interest, which is the date that you sign an agreement to purchase a property, and it doesn't matter if it is a conditional agreement or unconditional, so you can have a finance, builder report, any other conditions on that. If that agreement signed before 29th, then you'll be fine. You'll be still caught on the 2 years, not on the 5 years. But if it has happened after 29th of March, then you'll be falling to the 5 years. So that's how you indicate whether you're within 5 years or in 2 years bright line test. So assuming you're in a 5-year bright line test, the only other date that you have to keep in mind is a date that the counting on a 5 year starts. That date is a date that the title is get transferred to you. So if you purchase a property in 1st of April 2018, that's make you fall into the 5-year bright line. And if the property is transferred to you on 2020, 1st of April 2020, that 5 years starts from 1st of April 2020. So you have to go to 1st of April 2025 before you can sell that property without any capital gain tax. So keep that in mind. The things you can get caught is usually very unusual personal circumstances. It doesn't really quote the people who are actually doing it for making money. So as we know, 5 years is quite a long time and anything can change. So you might be moving overseas, you might change job, your cash flows change and you want to sell your rental property. So there are so many things can happen for you to decide to sell your property, and your intention never was making money, but unfortunately this rule will quote you. And you have to be careful what you're doing when you transfer the property. So one of the things I suggest is these days, if you have investment property, when you have a chat with your lawyer, after that have a chat with the accountant, make sure that you're not going to get caught in any of these new rules that are coming up. So make sure have a chat with the accountant and safeguard yourself. If for any reason you have to sell that property within the 5 years, the question is how the profit is calculated. So the profit is the purchase price minus the sales price. So the profit that you make is going to be based on that. If it's a related party, it would be the valuation, so the market value of when you purchased the property and sold the property. If you sold the property and you paid for agent, you can claim that. If you've done any other expenses for the marketing of the property for sales, you can claim those, home staging and all that, you can claim those because that helps you sell the property. The normal investment property expenses you would have claimed because you would have claimed your interest and rates and all that for your rental, so you can't claim those against. Those losses was already there and you claim those expenses. The only other expenses that is very important to make sure that you claim it is a capital improvement, because as you know, capital improvement we're not claiming, we can't claim depreciation. It is on your balance sheet, but it's never been claimed as part of the changes that happened before. And so the depreciation hasn't been claimed. So if you change the roof or if you made any capital improvement on the property, add a unit or anything else, those ones never been claimed as a rental investment property, but you can claim it when you sell the property. Naturally, because that increased the value of the property, they accept that to be claimed. So make sure, again, to have a chat with the accountant when you want to sell the property. to make sure that we have all the documents we need and everything that is in place, and we can do your tax return and make sure that you're taking advantage of all the expenses that is available for you to claim. The other thing that you have to be aware of, if you make any losses throughout selling the property in a 5 year, those losses cannot be claimed against your personal income. So those losses will be ring-fenced against any future property transactions or bright line transactions that you might have. So if you made $50,000 loss, because that happens sometimes, we've been on ups and downs of the property market all the time. So if that happened, that loss can't be claimed against your personal income, and it needs to stay there for future transactions and profit gain from property. One thing you have to be careful now, there are talks about ring fencing the losses from rental investment property as well. Next year that might come to effect. So you need to do some planning, make sure that you've got your cash flow and everything. If you're relying on those tax refunds that you would have received from the losses that you made on rental property, that might not come true next year. So make sure you do some planning. If that affects you, you're not going to be forced to sell your property, because there would be lots of property for sale, and you're not going to get the fair price when you want to sell your property.